Oh, yeah, it's ASA time. Welcome, everybody. Here we are. We got a special report today on Staffing Shark Podcast. I tell you what, this economy, I got to tell everybody out there, it is up and down. Is it a blizzard? Is it a hurricane? Or it's a tsunami? We don't know what it is right now, but I'm here with my special guest, the one and only Noah, ASA's chief economist and head of research. What's up, buddy?
How's it going? I'm doing well.
Oh, that's great, man. And you know what? I got to tell you right up now, I got a nickname for you. You ready for it? You are now called the staffing weatherman because the weather is up and down and unpredictable, man. And you try to predict it every day, right?
When people ask me what I do for a living, I usually just tell them I'm a glorified fortune teller because that's really what it comes down to when you're looking at the economy.
Oh, it's brutal. And you know what? Let's go back a little bit because I had some slogans back in the day. I said, staffing's going to be alive in 25 and all this good stuff. And everybody thought 25 was going to be the breakout year. And it unfortunately wasn't. So let's do a little recap there. How is people going to recover from this 25?
Yeah, that's a really good question, Richard. So actually, when it comes to just looking at the way that the labor market performed overall in 2025, it really didn't do bad. The labor market created nearly 600,000 jobs, which is just about the break-even rate that the labor market needs to be at in order for unemployment to stay low. Unemployment itself was at 4.4%, which means that the majority of people have jobs if they want them. Wages, they grew at a very reasonable pace. Now, the unfortunate thing is that none of those statistics that I rattled off mean anything to the staffing industry because the staffing industry, we are not needing a stable labor market to do well. We need a strong labor market to do well. And the biggest indicator of labor market strength over stability is hiring. Where employers are putting their money where their mouths are in terms of being able to create jobs and then also bring on new talent. And unfortunately, we really didn't see a lot of that in 2025. Hiring was exceptionally weak due to higher labor costs. And this is due to factors that have been building up over the past couple of years. That would include inflation, interest rates, with the advent of a new administration, tariffs. So what you see when you're thinking about employers is that they are facing all of these extra costs when it comes to bringing on new talent. So they now start to think twice about whether they really need to bring on as many people as they hope to bring on. And so when it comes to the staffing industry, which usually revolves around a volume-based model, right? You put more workers in with a client, and that's how you generate more sales. That really doesn't work in this environment where clients have every reason not to hire more workers.
You got that right. So let's talk about the unemployment rate. That's real quick off the bat. I got to tell you, everybody says it's kind of low, but I talk to so many people that's unemployed. What's going on here? How's that number look like kind of good? And then the real world says, no way.
Yeah, that's a good question, Richard. So looking at the labor market from 10,000 feet, only 4% of workers who should be in jobs right now are not in jobs. So that's a good thing. And that is exhibited by the fact that our economy has not seen a recession yet because the majority of people have jobs, they're earning an income, and they're able to spend that money on goods and services, which makes our economy churn. But here's the downside. What we're seeing right now is what many economists like to call a low hire, low fire environment. So on one hand, not a whole lot of people are leaving their jobs or getting laid off. That's a great thing. But on the other hand, there are not enough opportunities for workers to enter the labor market. So what that means is that if you're already on the inside of the labor market, if you're already gainfully employed, that's really good. Good for you. But if you're outside the labor market and you're looking to break in, it's very, very hard these days because, again, like what I said earlier, employers have every reason to think twice about who they're bringing on. And so because there's just fewer opportunities on the labor market. Those who are outside the labor market are going to stay outside of it for longer. And those who are inside the labor market, they're going to be inside for as long as they want to be. And that is the disparity when you see a lot of economists say, "Oh, we're at a 4.4% unemployment rate. That's really good."
Mhm.
And to somebody who's outside the labor market, they're asking, "All right, well, if the unemployment rate is so high, why is it so hard for me to find a job?" Well, again, it's good for folks on the inside, but not so good for folks on the outside.
Ooh, good advice there. I tell you what. Okay, so 25. Let's goodbye with 25. It's like goodbye. It's 26 time now, right? I mean, because I got to tell you what, we have high hopes this year. And I got to ask you straight up, man. Do you think staffing is going to pick up this first quarter? I mean, what's going on with business right now?
Yeah, absolutely. So the thing is that we actually still have 7 million job openings right now. And if the staffing industry was to even clinch maybe 5% of that number, we'd be able to double our penetration rate within the economy. So the real question is whether staffing companies are able to identify those pockets of demand that are existing right now. So there are two characteristics when it comes to occupations and industries that are beating this low hire, low fire trend, where we're actually seeing robust levels of hiring and churn amongst employers. The first criteria is that these are occupations or industries that tend to have a lot of personnel turnover. And one of the
Oh,
clearest examples of that is the healthcare field. You think about, say, nurses. There tends to be a lot of burnout as well as also, movement in terms of different opportunities that nurses can pursue. And so, with those dynamics, it's no wonder that the healthcare field has sometimes accounted for 70% of all job growth within the economy over 2025. So, what that would suggest is that pockets of demand where employers are still looking to backfill roles, that is one area the staffing companies need to look and focus on because that's where the jobs are being created. Another area that occupations and industries that are tending to beat the trend are in would be those segments in the economy that tend to be in really high demand right now. And I'll give you an example. With employers looking for more ways to do what they're currently doing, but with less headcount, a lot of them are turning towards AI or well as other sorts of technological innovations, right? You need computer scientists to do that. You need to have, your managers who know how to best integrate those technologies with the existing workforce. And so therefore positions like computer scientists or
mhm.
managers, they are still going to see increased demand because they have those specific skill sets. It's best right now to be a specialist, not a generalist. And so therefore staffing companies that do focus on, those high skilled segments, places like engineering, IT, and scientific services, professional and managerial services. Those are also going to be pockets within the staffing industry that are poised for growth because hiring trends within the labor market at large are actually beating this low hire, low fire environment.
Whew, that's a lot to take in right there. 7 million jobs. I got to tell you that. So it's 7 million jobs out there. Everybody's living on LinkedIn as we're on this platform right now. You're trying to find a job and they're like, I mean, no, I see people and I talk to them all the time. 2 years, can't even get an interview. I mean,
Yeah.
what do you think? Should they start, downsizing and take a job they're less qualified for, or what? Or I mean, they're overqualified. What do you think? I mean, what market do we do in the staffing industry to sell this talent? Because some of these people have been working for 25 years at this level, and they're getting job offers at this level.
Yeah, yeah. So I think that there are a couple of things that staffing companies can do right now that's going to allow them to take advantage of opportunities, however scarce they may be, within this low hire, low fire environment. First and foremost, staffing companies have an extensive knowledge of local labor markets. They not only have talent benches, but they also understand what occupations are in demand, how they are best being used by clients within their area, and also what are some of the uh, business as well as political dynamics that are going to be changing those labor markets. And so staffing companies really need to think about how they can best leverage that knowledge to be of use to their clients outside just being their source for talent. And so, one of the things that we at ASA have been seeing is that a lot of staffing companies are moving more into project management or consulting work. And that is really allowing these companies to take advantage of the knowledge that they have cultivated over decades, just placing talent, but also understanding the dynamics of how clients need talent and why talent goes into the temporary work space in the first place. Additionally, staffing companies also need to diversify their talent benches as well as their sectoral exposure. What I mentioned is just earlier is that there are very few pockets right now within the labor market that are actually doing well. Those segments of the labor market that either are seeing significant churn or those that are seeing a very high demand for their services. And so, if you're not in one of those two spaces, well, it's kind of hard to
Mhm.
thrive, especially using a traditional volume based model. And so therefore staffing companies that are going to do well within a lower churn environment, they're going to have exposure to many different sectors so that way they're able to take advantage of things like a federal spending on public infrastructure projects. It's going to be a boost to construction jobs, which means that there could be pockets of opportunity for temp workers within the construction space. Additionally, there's an increase in data centers that are being built. You need maintenance workers as well as technicians who understand those processes, and so being able to provide workers within that professional and technical services space. Diversification is also going to be key. And third, and most finally, is that staffing companies need to think more about how they can channel their knowledge of workforce solutions beyond placements, looking at things like being able to help their clients, think about, personnel movements and how they can complement, technological adoption such as AI, being able to, again, serve their clients in terms of thinking about total workforce solutions rather than just, simply talent placement.
Woo, there you go. We got a question real quick here. I got to throw this out there. What do you see in the manufacturing and production sector?
Yeah, that's a good question. So, manufacturing is really interesting because according to ASA's own data, about 40% of all temporary workers are in the industrial space. So that would include production workers, transportation and warehousing workers, and typically those workers are mostly found within the manufacturing industry, or the manufacturing sector, the construction sector, the transportation and warehousing sector. And so manufacturing has unfortunately been very hard hit by the labor costs that we have seen over the past year due to things like inflation as well as interest rates and tariffs. And so manufacturers are definitely still very much going through the ringer when it comes to these high costs and then their motivations to really hire more workers. But here's the good news. There are two long-term tailwinds that we're keeping track of that are going to be particularly beneficial to the manufacturing space. The first is going to be lower interest rates. The Federal Reserve has been progressively lowering interest rates since September, and usually it takes about 3 to 4 months for those interest rate decisions to
Mhm.
fully permeate the economy. And the manufacturing sector is actually one of the most responsive sectors to interest rate changes because wages are very dynamic and they ebb and flow with the economy. And so what that means is that with some of these interest rate cuts that are coming down the pipeline and expected to take effect in 2026, we are in fact going to see lower costs for employers, which means that that they might have more of an opportunity financially to bring on more workers. The other tailwind that we're looking at is the one big beautiful bill that was set into
Mhm.
motion this past summer. basically the One Big Beautiful Bill not only contained a lot of business-friendly tax provisions, which is going to allow for a lot of employers to keep more money in their pockets, but also it has earmarked money for additional investment within public works and infrastructure projects. And so we think that the One Big Beautiful Bill is also going to, by way of allowing employers to keep more money in their pockets, provide that opportunity for that money to be invested in headcount, providing opportunities for an increase within industrial temporary work and temporary work within the manufacturing sector.
You know what's wild about all that, Noah? Like even Big Beautiful Bill, we talked about it, had it on my show. It kind of like faded away. Like these bills fade away, but they make an impact with us that we kind of keep bringing them up. I got to tell you one thing. I think our industry right now, and maybe, you know me, I'm outspoken, is I think we're like a bit in fear. We're on defense more than offense, which I always say you should be on offense because tell people out there, don't listen to all the media because it will just sink you and confuse you altogether, man. I got to tell you. But I got to ask you one thing here, like tariffs. Can we deep dive a little bit about tariffs? Because, you know, they were big this summer and stuff like that. How are they affecting the staffing industry right now?
Yeah, that's a really good question. So, unless you are the listener or who was asking about the manufacturing sector, tariffs are not really going to have a whole lot of an impact from a labor perspective on much of the labor market other than the manufacturing space. The reason for that is that employers have to spend more money on the goods that they're importing from abroad. Usually, these are either finished products that they then directly sell to a consumer, or they incorporate these goods within the products that they're making here in the United States. And so the thing is that when these products cost more, that means that employers are spending more in terms of their operating costs. And the money that they're devoting towards tariffs and those operating costs is money that they could be using to bring on additional headcount. So we've seen tariffs raise costs and further depress labor churn within the manufacturing space quite a bit. But for most other segments of the economy, tariffs really have not had that same sort of effect from a labor perspective, because there is another way that tariffs work. When people are spending more of their money on buying goods and services at a higher price, that means that the growth rate of prices increases. That is called inflation. And inflation, when it is too high, is what causes the Federal Reserve to raise interest rates or the cost of borrowing more money higher. So that way people don't spend as much. And the point of why I bring that up is because inflation and then interest rates, it leads to a vicious cycle where once again employers are seeing their labor costs increase more than they need to. And so in both ways, whether employers are spending more money on operating costs as they would within the manufacturing space, or whether tariffs are going to increase inflation and therefore increase, labor costs for everybody, it's going to be another reason why employers have to think twice about hiring more workers, and and less hiring means fewer opportunities for our industry.
Wow, well said there, man. You know what? You know what I love how you broke that down about tariffs, because I think a lot of people don't understand the pros and cons with it. You know, they just see a little bit about it, but you broke it down right there in 3 minutes. Boom! I told you all, bring your pen and paper to this, man. No pads. I got to tell you, I'm going to make this a flip book for like 20 pages. Noah, what you just did right now, man. This is incredible stuff. Something else before we wrap things up is AI, the AI adoption. Is this affecting the staffing industry a lot with what's going on with AI?
Yeah, it's a really good question. So, looking at it again from that 10,000-foot view, as what you said earlier, the media tends to blow things out of proportion sometimes when they say that AI is killing jobs left and right, and that within a couple of years, nobody's going to be working because AI is going to be doing everything for us. That really isn't the case. And actually, when it comes to the layoffs that we're seeing right now within the labor market, the majority of these layoffs have to do with economic conditions right now. Just what I mentioned earlier: inflation, interest rates, uncertainty about where the economy is going to go, etc. The advent of artificial intelligence, though, is what's leading a lot of companies to use it as an excuse to cut headcount in order to remain viable within a rougher economic environment. So you'll see, say, CEOs saying that, we don't know exactly what kind of disruption AI is going to have, but we know that we need to get ahead of the curve. And so in order to do that, we need to right size our workforce. And so even though it's mostly a move to be able to jive better within a rougher economy, employers are blaming artificial intelligence for some of their for some of their changes in personnel. But how is it affecting the staffing industry? Well, the ASA has also done some research on what is the current level of AI disruption on skills within the temporary work space. And what
Mhm.
I mean by that is that what we've been able to do is that we've been able to divide the temporary workforce by different occupations. Your managers, your computer and mathematical occupations, your production workers, etc. And we've been able to look at how AI is going to change the types of tasks that each of those occupations are expected to perform. Now, a stat that I mentioned earlier was that about 40% of the temporary workforce, it consists of production as well as transportation and warehousing employees. These workers are only going to see maybe 2 or 3% of their tasks automated or augmented even by artificial intelligence. Conversely, though, you see educators, mathematicians, and computer folks. Those are occupations that comprise a much smaller share of the staffing industry, but are seeing closer to 25 or 30% even of their tasks being somewhat affected by artificial intelligence. Now, there's actually some data that we do put out within other ASA products, our weekly economic and business outlook, as well as our staffing stats webinars. We do show that overall, the impact of artificial intelligence is projected to be small because there's very few workers that are working in occupations that are very exposed to what AI can do right now. And
Mhm.
so, but that's something that I would recommend that folks check out if they can.
And the final thing, and I keep saying this, AI is not going to take your job. You got to learn it. It'll
Yeah.
replace you if you don't know it. Before we wrap it up here, I got to ask you. So, can you give me like 3 strategies here that, like, if you were a staffing firm right now and they're like, no, I love all this information, it's like, they're going to probably rewind it over and over again to take it in because this is good stuff. This is great stuff to listen to all weekend. What would you tell a staffing firm right now? The most important couple, like 3 strategies here to overcome the first quarter here.
Yeah, absolutely. So let's just recap here. Right now, we're coming out of a rough 2025, and we're hoping that things are going to get better, but still hiring and labor churn is very much down. There are fewer pockets of opportunity to take advantage of. And so therefore, what I would recommend to staffing companies, number one, make sure you're diversified. So that way you have access to many different opportunities within the labor market. And that way you can also take advantage of some of those occupations and sectors that are experiencing growth. Number two, make sure you're thinking bigger about how you can channel your knowledge of workforce solutions outside of just talent placements, being able to really provide that value to clients when they're not necessarily looking for volume. And then the third is being able to demonstrate your knowledge of local labor markets. Listen to your news, listen to fellow economists like myself, or just keep on top of trends that are going to be impacting the businesses and your local economy. So that way, when you come into a meeting with a client, you know exactly the sorts of dynamics that are coming down the pipeline and how your client is probably going to be thinking about their personnel decisions at that time. Staffing companies want to be those folks who can anticipate the future before their clients do. And being able to do that is going to be the key differentiator for staffing companies that succeed or don't succeed within a tight labor market.
There it is. I mean, can I say any more hype about that? Noah, you brought it today, man. 25 minutes of pure knowledge, man, about the economy and everything else. Thank you so much. I got to ask you real quick here. Where can everybody reach you at, man? I mean, LinkedIn, what's the easiest way?
Yeah, absolutely. So, first of all, I would just highly recommend that folks check out the research department page on the ASA website. And if you do have any questions, just contact us at research@asa.net. And then additionally, you can find me on LinkedIn. I'm pretty active there. I'm just Noah Yosef, as you see my byline, and always happy to talk about the labor market, the staffing industry, or anything else that comes to mind.
I love it. All my SA peeps out there, definitely reach out to Noah. And if you know what, you're not part of ASA, I'm going to give a plug here. Join us. Look at all this information you're getting, and it's on the website and more. I mean, Noah's doing research 24/7, so learn from us. Join ASA today. All right, brother, can I give people the news of what we're going to do this year? Can I break it to them a little bit?
Yes, sir.
Breaking news here. Me and Noah is going to team up here in ASA, and we're going to do every quarter, we're going to have Noah come on here on the live stream here to give us all the insights from they did today. Now we're going to continue that on. But Noah, I'm going to throw you on a curveball on this, but I think one show should be a Q&A with everybody in the audience to ask the questions. What do you think, man?
You know, I personally love to be kept on my toes. So, why don't we just do a Ask an Economist? Come with your best questions, and let's see where the conversation goes.
I love that. Or ask the staffing weatherman. That's who he is now. Yeah. Remember, that's his tag name, the weatherman, buddy, because he knows what's up. Hey, Noah, thank you so much for coming on, brother. I love it. Can't wait to team up with you again, man. And have a blessed day, brother. And we're out of here. That's a wrap. See you guys soon. Take care.